Thanks, Dave. Thanks for tuning in, everyone. A lot of good presenters today and some great takeaways throughout the session. So we're going to close things out here talking about building a profitable trading strategy, specifically to futures trading, but a lot of the concepts that we're going to talk about can be applied to stocks, options, other markets, Forex, but I'm going to pull specific examples from the futures markets because that's what I trade. So as Dave mentioned, my name's Tim Racette. I blog. My website is EminiMind.com. You can find me over there. So let's jump in. A little bit about me. I have been trading since about 2006, and I primarily trade the futures markets. I'm from Chicago area originally, then went to Arizona State University, and I currently live in sunny Scottsdale, Arizona. So I've had the pleasure of speaking at a number of these festivals, as well as the CME, Traders Expos, money shows, things like that. So I always enjoy getting together with other traders. I'm sure most of you know that where you're at, unless you're in a Chicago or a New York or even like a Philly, there's not access, or at least very easy access to other traders, and connecting with traders can be tough. Years and years ago, there used to be a lot more meetup groups and things like that. And growing up in the Chicago area, obviously we had lots of access to the trading pits and traders around Chicago as well, that were trading on the screen as well as down on the floor. And Thinkorswim and a lot of the brokers and things were based out of Chicago. So a little bit of a leg up for myself and a couple of my trading buddies growing up in that environment. Outside of trading, I spent a lot of time riding my bike, getting outside, hiking, exploring, pretty much doing anything outdoors. I like to focus my efforts in trading at the open and at the close, and then that allows me to kind of free up most of the middle of my day and get outside, keep a clear head, and all of that stuff that you do outside of your trading has a big impact on your trading when you're sitting in front of the computer. So when I first started, I would sit there all day and even wake up for the European session and trade that for an hour. But in the long run, that's really not sustainable to be there with the split sleep schedule and then be there all day for the NYSE session. So I found that my most profitable time in the markets was at the open. So that's what I settled on, and that's what I've been doing for the last 15 years or so. I will keep my eye on the question box. So if you do have questions as we go here, feel free to type them in, and I'll try to knock those out as we go so you're not waiting until the end. So there's a couple things that I've learned in life and specifically in trading that really helps accelerate your success. And I'm sure a lot of you know that with trading, when you have success in other businesses, I have a lot of folks that I talk to and have connected with over the years that were, successful doctors, lawyers, everything under the sun, business owners, real estate brokers, all kinds of successful, from entrepreneur, specific entrepreneur to something like a doctor that is just a very high level of intellect. And then you turn to trading and you find that some of the hustle characteristics, the studying, the working hard, doesn't directly transfer to returning a profit. And a lot of times, you probably noticed that the more hands-off you are with your trading, the better the results are. For most folks who have a 401k or a state retirement or some type of auto draft, transfer from your paycheck into a retirement account that you just forget about and you don't even see that money, those are the accounts where you look back 15, 20 years, after 15, 20 years go by, and they've grown, an immense amount. And so the hands-off nature of that kind of investing can be applied in certain ways to trading. And so successful trading really requires, three things. We need to be able to commit. And when we commit to doing the small things, the little things that no one else sees but us, that's what helps bring about the big results that everyone else sees, and that's what they want. You can say the same thing about musicians or actors or pro athletes. I'm a little bit, I guess, biased or have experience in kind of the pro athlete realm from the cycling world. And so there's a lot of parallels and examples, I guess, if you will, or analogies from competitive cycling that I've been able to apply to trading. And the sports world also has a lot of great examples, but committing, and that's kind of the very first step, probably the easiest step to do. Most of you that are here today have committed to learning to trade, to expand your trading, or, enhance your trading to a point that it turns into consistent profitability. And my real goal for today's presentation is not necessarily to give you a brand new strategy. It's to take the strategy that you have, will rework a few things. You could say maybe manipulate it in a way to where we can turn it from break even or losing money into a profitable endeavor. So commit is, we can kind of check that one off the list. The next one is we need to build confidence, and consistently taking action is the best way to help build that confidence. When we're sitting there stuck with a blank canvas and we're not sure how to get started, that's the worst feeling for low confidence. But if we can start taking small actions, even basic things like, okay, I'm brand new to trading, I need to open up a brokerage account and then fund the account, and all of those little things, you start taking small action steps, and those help snowball and kind of get you moving. And I had a friend and mentor when I was younger tell me that it's better to take small steps forward and make a bunch of small decisions than stew and think and not take an action and wait to make a decision. If you just take small steps, make small decisions, you can easily change course. Maybe you open a brokerage account with one firm and you realize, oh, I don't like the way the charts look. I'm going to switch gears and open a brokerage firm over here. It's easy to, close the account and move things. But if you start to take small steps, then that momentum helps build. And that helps build the confidence that transitions into, mastering your setups and getting a rhythm going with your trading and becoming a master of your craft. And the third thing we need is that consistency element. And this is, for most folks, they kind of get stuck somewhere between, step 2 and 3, if you will. And a big part of gaining consistency is creating repeatability, something that you can do every single day, an approach or a routine that you can repeat day after day, and a strategy that you can repeat. And getting lucky or unlucky here and there, just trading on impulse occasionally, getting lucky, occasionally getting unlucky, those trades don't feel as good as when you execute a specific setup and you can repeat it day after day. And so that repeatability is really where the value is in kind of the first step towards becoming consistent. So it's important to keep it simple, because as the market environments change and volatility changes and global markets shift, the simpler you can keep your strategy, the more likely it is to work over time. If you have too many variables input into your trading strategy, then as soon as volatility changes, then you have to go back to the drawing board and revamp things. So keeping it simple, and then also practicing mindfulness and being very intentional with what you're working on that day and that week. So, mindfulness can be everything from, going for walks and getting exercise and eating good and visioning your trading, but it can also take the form of being intentional with, okay, today I'm going to really focus on adhering to my stops. Today I'm going to really focus on getting in the trade and then sitting on my hands, not micromanaging the trade. If you say you're going to have a target at X number of points, sitting back and letting the trade work versus getting subjective about it and emotional and trying to micromanage it, having a very intentional practice each day and each week. Maybe, the start of the week, you say, I'm going to really focus in on this piece of my trading. And for the whole week, that's the focus. And if you can kind of break down the steps, so if you think about like, basketball game or shooting free throws, all the pieces, well, the whole basketball game in general, all the pieces, you got free throws, you've got, the defense, the offense, all the pieces that create a winning team. You can break those things down, and then as you're in a practice environment, you can just isolate the free throw with no distractions, no crowds. You can practice, being the defender in front of the net and work on the same drills over and over again. And we can use those same kind of idea with our trading and practice certain pieces of our trading each day and each week. So I always like to, kick off with Warren Buffett's rule, because it's a good reminder that if we get too distracted or too focused on making money, we can lose a lot of money. So the most important rule is to preserve your capital. And the second most important rule, don't ever forget rule number 1. And when we come at trading from a risk-first approach, it really helps keep us in the long game. If we are constantly focused on, crude is up, or Bitcoin is up, or this is the hot market, gold is at all-time highs, I need to be jumping in, and you're kind of seeing dollar signs, that is a big red flag. If you're looking at the market as, here is an opportunity, where is my risk? Where would I be proven wrong on this trade? Where does my stop or exit point need to be where I am invalidated, where my original thesis is incorrect? And then, with futures, for most folks, you're probably day trading. If you were swing trading stocks or ETFs, you could use the same approach, calculating the number of shares you would buy to keep your risk a certain amount. Maybe you say, I trade 2 E-mini S&P contracts and I want to risk, $200 per trade. And so laying out the risk side of things first is super important, because most folks experience plenty of winning opportunities. The trades might not always materialize to winning trades, but if you go back to your trades over the last couple of months, and the last, I would definitely say the start of this year has been a challenging time whenever we're in kind of a consolidation, especially when it's up against all-time highs. It makes for some very sporadic trading and not as consistent day to day. So, let's say you go back the last 6 months, there's lots of times where you were probably in a trade, and had you been able to follow your plan or stay in the trade longer, or simply trail your stop the way you kind of envisioned, the trade would have been a nice winner. But instead, by micromanaging the trade or getting scared and closing out the trade early, you end up, only bagging 2 points instead of 10. And so if you can focus on the losing side, how can I reduce my number of losers? How can I take quality trades and make sure that I don't end up with a big losing week or a big losing day that gives back the entire month of profits? Then if you can just let those winning trades work, and for most folks, following some sort of simple exit approach, whether it's a fixed target or simply trailing your stop, then the winners kind of take care of themselves versus coming from the angle of trying to add more trades to get more winners. That's typically not a very wise way to go about it. If you can help reduce the risk, if you can focus on reducing the risk, then the winners are there. They just need to kind of materialize by you being a little bit more hands-off as the trader. So we're going to talk, just run through kind of an outline of what makes up a solid trading plan. And I always like to start with kind of some bigger goals and then your beliefs about the market theory, and then the actual kind of nuts and bolts, the trading methodology. How are you going to manage risk? What rules are you going to use for your trading strategy? The system that you use, are you going to use, moving averages, price action, Fibonacci, market profile, and then kind of getting into the psychology portion with how you're going to manage your emotions, what routines are you going to put in place to help manage those emotions, and then the business management side starts to take into account record keeping and various checklists and things like that. So we're not going to go through all of these pieces today, but that's just kind of the way that I like to outline a comprehensive trading plan. So we're going to touch briefly on goals and market theory, but then we're going to spend the rest of the time in the trading methodology portion. So for goals, something that can get lost as you begin to trade is, it can seem daunting to be trading and then sort of having this thought of, well, I need to make $10,000 a week, or I need to make 100 points a week. And if you really step back and just ask yourself, okay, what is my goal or motive? And if you picture what a perfect day looks like, maybe you're already retired and you just want to go play golf or spend time with your grandkids, and a few $1,000 a month on the side would help not have to draw into your retirement. Those kind of, what's your motive for trading? And so if you picture what your perfect day looks like and who you're with, what you're doing, and then what that costs to do that each month, that kind of becomes your number of, okay, really I only need to make $1,000 a week, $4,000 a month to live, this lifestyle. Maybe it's $14,000 a month, whatever it is for you, but a lot of times it's less than people think. And then that sort of feeds into the way you're going to structure your strategy, how many contracts you need to get to, how much profit per trade that you realistically need to achieve in order to hit some of those goals. So if you start from kind of a holistic approach, or what our objective is, then from a monetary side, that can help kind of shape, okay, actually I really only need to make 20 points a week. And if I do that with one contract, that's 20 points I need to make. If I do it with 5 contracts, that's 4 points per contract. And so then that can kind of shape the type of trading that you do, how big your profits are, your relationship of your stop to your target. And then we can kind of, I used the word earlier, manipulate or sort of shape our trading to reach those goals, as opposed to just finding a strategy on the internet and trading it with one contract and then not really having a plan for how am I going to scale this. And then from a market theory perspective, the more you believe in the strategy you're trading, the better you're going to trade. And so having some basic ideology, things that resonate with you, I always tell myself that anything can happen. We could be, and this last week is a perfect example, market's getting ready to sell off and then boom, we're an hour into the day, there's a tweet and then bam, we're making a new high in the day. And so anything can happen. Yes, I want to look for quality setups, or what I call valid setups. So if I have my, a note card with my trading criteria on it, if I go through that checklist, yep, this trade setup meets all 4 criteria, then it's a valid trade, regardless of the outcome, whether it's a winner or loser. If it's a valid trade at the time of entry, then thumbs up, it's game on. And so anything can happen. A perfect setup could turn against me and stop me out, and a A-, B+ looking setup could end up being a big winner. So anything can happen, and then the market is always right. So even if it looks like, or it feels like, or the news is telling me negative, 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 if the market's going up, I need to be conscious of that. And not that you always have to trade with the trend, but if your strategy is, for most people, based on more of a technical nature, then what the market is telling me is what I'm seeing. So trading what you see, not what you feel. And then I always remind myself that there will always be another trade. So whether I missed a trade, or I wasn't there for a day because I had something else going on, or I had a losing trade, there's always going to be another trade. And so that helps keep me patient and understanding that I don't have to force anything. I don't have to make a trade. That's something I always have told myself when I come into the day. I don't have to make a trade today. Kind of letting the market come to me, let the trade setups come to me. And there's periods where, a lot of people want to go from a 9-to-5 corporate job and make $200 every single day trading. And what I've found, and my other trading colleagues, that some trade similar to me, some trade other strategies, it's not as consistent as that 9-to-5 job. It's more, you go through periods, you have a couple of weeks where trades are firing off left and right and everything is kind of hunky-dory, and then other periods where it's Friday and I've only had 3 trades this week and there were no setups on Tuesday and Wednesday. So the P&L is not consistent day to day, but if you shoot for monthly profitability, even you can shoot for weekly profitability, let's say shooting for 20 points a week, but just know that there's going to be times where there aren't very good setups. And if you force trades in that environment, that's when you can really dig yourself a big hole. So just a small note on times to trade. So when I first started trading, like I said, I traded all day long, and you can kind of break the trading day into 6 sessions. So you got the pre-market before the NYSE open, hour and a half before the NYSE open. The best time at the NYSE open, and then that morning, so like the first hour and a half to 2 hours after the NYSE opens, that's when the most volume. You have the London overlap, and so that's when most of the trading activity happens, and that's the window that I choose to trade. Then you have the lunch hour. Rarely anything is going on through that time. Afternoon starts to pick up into the close. That the kind of the last half hour can be very reactive and can really burn you if the market is moving in kind of a reactive manner. And then you also have the European Open. I didn't mention after hours because the volume is so low in the Globex session that it's really not worth your time to try and trade it. There's more volume and usually in the first 15 minutes at the NYSE Open than the whole overnight. The European Open can be a good time to trade, but it just kind of depends on your time zone. If you have the ability to trade the NYSE Open in that morning session, that's going to be the best. So from a trading methodology perspective, we talked about things need to be repeatable, and creating that, having a very simple strategy that you can repeat is much more valuable than a very complex strategy or something you don't understand. There's hundreds and hundreds of strategies and ways to trade, and on their own, most of them do have an edge, and most of them can be traded successfully. And the more you kind of master one market, one time frame, one strategy, at least for starters, then the easier it is to then expand to either other markets or other time frames, or just add more contracts and do the same thing, do one thing really well. Trading is something that you get rewarded for specialization. And if you can do one thing very well and repeat it, you can go from 1 to 2 to 4 to 10 contracts and 10x your income just by the click of a mouse. So price action is something that I lean on a lot, just basic candlestick charts. You can pick 1 or 2 indicators. I do tend to look at the 21 exponential moving average, but I don't have a whole lot on my screen. I don't have MACD, stochastic. There's thousands of indicators out there, and the more you can just focus on the basics of higher highs, higher lows, lower highs, lower lows, that market structure that you hear about, and the more you watch one market, for me, it's the E-mini S&P, the better in tune you'll become, and you can start to spot things that if you're watching 10 different markets, it's hard to pick up on little nuances and things like that. And like I said earlier, keeping it simple will very much, you'll thank yourself the simpler you keep your trading strategy. So one good exercise, if you do have a trading plan, document, or something written out, or some rules, print it off and go through and ask yourself, okay, do I need this specific rule to place a trade, to enter, manage, or exit a trade? If not, cross it off. With your trading screen, let's say you have 3 monitors, go through each individual box or chart and say, okay, do I need this time and sales screen does it help me enter, manage, or exit the trade? And if the answer is no, get rid of it. So simplify your trading screen, simplify your trading plan. And then what we really want to do is focus in on the numbers. And there's a lot of good trading journals out there. I've always just kind of defaulted to Excel and kind of doing my own trade logging, if you will, but most platforms have some kind of built-in trade journal or export feature, and you can quickly get all of your data. And we're going to get into the important metrics here in just a couple minutes. But one thing I like to pay attention to is how much profit did I have on the trade? How much did my losing trades, how much did the trade go in my favor before I was stopped out? And then on the other end is how much heat, or how much did my winning trades go against me before they turned into a winning trade. And so if you're finding that, okay, go through, take 50 of your last 50 trades and then pull out your winning trades. If you have a 5-point stop, but 90% of your winners are only going 3 points against you before they turn higher, well, that's good reason to maybe tighten your stop. And then from a max profit perspective, if you find that you have a 10-point target, but you have a lot of these losing trades going 8 points and then turning around, that can be a small indication of maybe I need to bring in my target. Looking at that relationship of reward to risk is super helpful. A good starting point is kind of a default, is just to use 3 to 1. So if you have a 2-point stop, use a 6-point target just as a starting point, because that allows for multiple losers to be quote unquote made up by one winning trade. And then a lot of people like to chase winning percentage and focus on how can I have as close to 100% win rate as possible. But what that does is forces you into making kind of bad trading decisions, moving to break even when the trade's only a point in your favor. Then you get taken out for break even, and then it shoots up 10 points. So giving the trade some room to work, not focusing so much on winning percentage, as we'll talk about in just a couple of slides here, can do wonders for your trading. So be selective with your entries and don't add too many rules. Otherwise, what a lot of people end up doing is kind of curve fitting their trading to the last 3 months. And then when the market conditions change, then all you have is just kind of a curve fit strategy that isn't really repeatable. And always be thinking about how can I scale this? How can I grow my trading? So a couple of strategies that I wanted to just highlight real quick as some examples. 15-minute opening range breakout. Basically, once the first 15-minute bar forms, placing a buy order 1 tick above highs and a sell order 1 tick below lows. Using a 4-point stop and a 20-point target is how I've traded it over the last 5 or 6 years. So you have really large reward to risk when volatility is low. And then the volatility does shoot up. We've seen it jump here in the last week or two. When the volatility is above 25, then I widen my stop to be either the other side of that 15-minute bar. So if the first 15-minute bar was 10 points, I would have a 10.5 point stop, and then that same 20-point target. So that's kind of an example of just a very basic framework for a repeatable strategy, and then some additional parameters to help reduce risk and reduce drawdowns are days not to trade. So like the FOMC Wednesday meeting announcement, typically in the morning, there's not much going on, and so you have a much higher likelihood of just not having much action on that day. So next Wednesday is actually going to be the meeting announcement for this kind of 6-week cycle. Futures expiration Fridays, I always take off because some weird things can happen when you have rollover week, and then expiration day, there's just a greater chance of things being a little bit wonky. And I always take off the last 2 weeks of the year and the first week of the year just to kind of reset and then ease into the new year. Another strategy that I use a lot are 1 minute, on the 1 minute chart, are hammers and inverted hammers. And so just identifying that candlestick pattern on the 1 minute chart and then using that 21 EMA to help identify the trend as a simple visual. And then just with a 3-point stop and a 6-point target, getting in 1 tick above a hammer or 1 tick below an inverted hammer. That way I'm kind of getting in with the momentum. When we pull back in an uptrend, the hammer is kind of that reversal signal, and the inverted hammer is also a reversal signal. So hammers in uptrends, inverted hammers in downtrends. And then the 30-minute, or the third strategy, 50% retracements. And a lot of people like to look at Elliott waves and Fibonacci. So just using a basic Fibonacci retracement tool and picking 2 points on the chart. And if we're in an uptrend, if we're making higher highs and higher lows, looking for longs. And if we're in a downtrend, lower lows, lower highs, looking for shorts. And so again, keeping things very simple, but just having a framework or a lens to look through and entering at the 50%, putting your stop outside of the 60-1/8, and then either targeting the -23 or just trailing your stop. With halfway backs and retracements, I find that you can get into some really big runners. So I'm a big fan of trailing my stop just by, if I'm long, trailing higher lows as it's moving up, or if I'm short, trailing lower highs. And then this is probably one of the most important pieces that we'll kind of get ready to wrap things up with. But the calculations that you want to look at are your winning percentage and your losing percentage, as well as kind of the most important pieces are your average winner. And then these three metrics play into your, I guess, if you have your average winner and your winning percentage, you can get your losing by just subtracting from one. But the two pieces that those metrics help give you are the R multiple and the expectancy. So your R multiple is your relationship between reward to risk. So if you have a 6-point target and a 3-point stop, that's a 2-to-1 profit factor or 2-to-1 R multiple. And the expectancy is how much you can expect to make per trade. So if you have 50 trades, half of them winners, half of them losers, you can plug in your winning percentage, your losing percentage, the average winner and the average loser to get the expectancy. Or if you're in Excel and you just have a column of all your trades, you can just do a quick average, and that will give you how much I'm making per trade when I account for the winners and losers. And these four metrics, winning percentage, losing percentage, average winner, average loser, are the pieces that will help determine and kind of, those are the pieces you can manipulate by adjusting your stop size, your target, the number of trades you take to help get you to a positive expectancy. So you'll be able to get the recording, and I can send out this this chart as well, or this screen with the calculations. But the R multiple and the expectancy are the two most important pieces of your trading strategy to calculate, and you want to have at least 50 trades in your data set. If you have a really small data set, it doesn't really help to kind of weed out some of those curveball pieces. So I always like to kind of wrap with just the idea that you never want to leave things till tomorrow that you can do today. A quote sometimes attributed to Ben Franklin and others, but it's important to take little steps every single day, make small decisions every single day to kind of keep building that snowball and building that momentum. So if you do have questions, I've got my email there. Dave will be able to send out the recording as well, so you can review it. And if you do have specific questions to trading or the strategies that I use or anything like that, feel free to shoot me an email. I'm happy to chat. So thanks for having me, Dave, and I appreciate everyone tuning in.